Hey y'all, welcome back. Today I want to talk about Grant Cardone's Bigger Pocket podcast and the lessons I learned from that. And there are a lot of lessons. So let me start with just sharing that I learned that he now has 12,000 units under management. The last time or in December when I was in Aventura, Florida at his real estate summit, when I first entered into the Grant Cardone universe, he had 10,000 units, but now it's up to 12,000 units um, owned, and then he manages 21,000 units. So that's one and two. Number three, the average rents are 2,100 per month. So wow, that's a lot of money. In fact, I'm going to do the math quickly and just see. If Grant Cardone has 12,000 units that are bringing in 2,100, wow. So every month, y'all, Grant Cardone is making $25,200,000 from those 12,000 units. That's why this real estate game is so worth getting into. Now, he's been in the game for 37 plus years. And for many of us that are getting in, we're just getting into the game. But this is amazing, right? 25,200,000 every month of passive income. So whether he does something or doesn't do anything, that money is going to keep flowing. Wow, that's amazing. Number four, he says real estate is the safest investment in the world, and especially multifamily real estate. And I can understand this. This is something that he's taught me since I entered into his universe in December last year, December 2022. It's very clear that if you have that number of units, 12,000 units under management, it's pretty safe, because even if 10% of the people are not paying you, you still got what, 2 million or 23 million or so still coming in, right? That's pretty good. I didn't know this part of his story. So number five, he said he sold 90 units in California, and he also sold his home, and he pulled out the equity from his home and went and bought 2,000 units in Florida with that money. So that's how he really started big in Florida, and now he is one of the biggest real estate owners in the state of Florida. What I loved about this particular story and tip is this is something that I've heard a lot about, and I've been thinking about, and I'm even developing a product around this. And this is this idea of home equity. Many Americans, myself included, are sitting on equity in our homes. But while we sit on that equity in our homes, the what the equity could do for us is the equity is not able to do much for us, is what I'm trying to say, right? If you're able to monetize that equity, then it would be super helpful. And for those who know or may not know, the tax angle to the equity in your home is you could pull 250,000 if you're single, or 500,000 if you're married, of equity from your home when you sell it, tax free. So I'm working around like creating the understanding around how to benefit from this home equity, and I'm calling it a home equity strategy. So I'm still in the lab, but we'll be coming out with it sometime in the near future. Okay. So that was number five. Number six, he says he believes we're already in a recession. So here he talks a lot about how government lies, and first of all, they've already changed the definition of what unemployment is. And if you look at the financial decisions that the Fed has been making, and the layoffs that many of the companies are executing, believes very much that we're already in a recession. So he says we should all think and act as if we are in a recession, which implies that there will be opportunities coming up, but then you have to make sure that you use your money wisely to get really good assets at great prices. Number 7, he says, because he believes we're in a recession from last year, and this I didn't know because I don't recall him sharing this, for example, in the real estate summit in Aventura, Florida in December 2022. But he says he's walked away from 4 deals worth 1.2 billion, and he had 2 million in earnest money in those deals that he was willing to walk away from. But he says he got the 2 million back through negotiations. Number 8, he says he's making billion-dollar plays. And so speaking about the 2 million, the earnest money, the reason why he walked away is because he's making billion-dollar plays, so therefore he's willing to risk 2 million any day for a billion-dollar play. He also talked about his 1, 2, 3, 4, 5 categorization of things and how that helps him to make very quick decisions. So for him, 1 and 2s are things that he's got to do, and 3 is something that maybe he should do, 4 is something that he shouldn't do, and 5 is something he definitely won't do. So 3, 4s, and 5s he just dismisses offhand. 1 and 2 he does, but prioritizing 1 over 2. Number 10. So he says he's hunting for deals, and I thought it was noteworthy to grab like the states and write them down, or write down the states that he's deal hunting in. So Arizona says is his favorite state right now. Florida comes next, and then Alabama, the Carolinas, Texas, and then Colorado. So I love knowing where smart investors are buying properties. So when we have raised our fund and we're ready to go, we know the markets in the US to go after. Number 11. So he says he's got to be in landlord-friendly states because these landlord-friendly states make evictions easy. And not that he wants to evict people, but he's experiences that once tenants are aware that eviction is possible and is easy, then they tend to behave differently and better and not try to game the system by using the law not to pay and to stay at the same time. Okay, and then number 12, he also looks for states or cities or neighborhoods where job migration is positive. The one thing I'll say about Grant Cardone is being in his universe has taught me that he's very, very numbers driven. And it's refreshing to see that this notion of evidence-based that is so big in companies like Google and Facebook, Meta, is also big for one of the bigger real estate investors. So I really admire how much he A, knows the numbers, but also B, how much he pays attention to the numbers. All right, which is slightly different from Barbara Cochran's strategy, for example. But this is what I love about real estate. It just keeps encouraging me by showing me that there's more than one way to do this, right? So that old saying of there's more than one way to skin a cat, which I always wonder about, like, who was skinning a cat and like how do they discover that there's more than one way? Anyway, I digress. But specifically, it's just so refreshing to see that there's more than one way to do this. There's more than one way to win in this real estate game. That's really encouraging. So for me, that encourages me to, model, but also build my own way. All right, so what's the next one? Number 13, he says he prefers to be in a warm state. He doesn't understand how or why anyone would want to live in a cold state. And he believes that warm states also attract renters more easily. Didn't quite put it that way, but that's the gist of what I got from it. Number 14, he says he looks for institutional quality assets because when he goes in, he's got to know the exit when he buys. So he's buying what institutions are buying. So if he's ready to sell, he knows the institutions will buy it. And number 15, he seeks to understand what are the institutions buying, where are they buying, and why are they buying. Number 16, he says people think they make money when they buy, but the truth is you got to know what your exit is and have multiple exits. That's how you make money. Number 17, he says there are levels of returns. So there's cash flows, there's depreciation, there's bonus depreciation, and accelerated depreciation. And one of the things I've discovered is that if you're buying international assets, like the property deals in South Africa that we're trying to take down, you don't get bonus depreciation, but you still get accelerated depreciation through cost segregation. But again, I digress, and probably a conversation or a video for another day. But let's continue on. Grant Cardone and his Bigger Pocket podcast, or his appearance on the Bigger Pocket podcast. And then he talked about number 18. He had when he had 3,000 units paying him, like initially started out, he bought C's and B's. I guess that makes sense because he was starting out, and for many of us, when you're starting out, that's what you can afford. I know when I came into the game through his universe and his orbit, I started looking out for A-class assets because I like expensive things, or at least I have a taste for things that are nice, right? So whether expensive or not, and A-class properties attracted my attention because they're beautiful. And I learned very quickly that, it's not so easy to buy A-class assets when you're starting out, because most of the people that you would want to work with also will say to you, like, well, you shouldn't work on something you can't take down. And so my response to that has been like, well, how can I raise money and learn how to raise money, raise a fund so I can take these things down? But that is a journey, that's a journey that I'm on. All right. Number 20, he says during COVID, he dropped the pref. So this is the preferred return using the waterfall method and style of fundraising with limited partners and general partners. If you don't know what general partner and limited partner are, drop me a line in the chat, in the comments section, and then let me know if that would be helpful for me to make a video about that. Okay. What else did he say? Yes, so he dropped the preferred return and increased the quality of the assets. So he started looking for assets in the best location, and he bought in preferred location. Excuse me, it's a bit late, but important to get these videos done. So he's holding assets for 10 years. That's his plan. Number 21 says rents don't increase at the same rate as the preferred. And then he went into a pretty eye-opening conversation about preferred returns and how capital raising is done. And he talked about number 22, the preferred return is an inherited broken concept from the past. So he talked about the fact that, or at least his view, that the capital raising started off with a small group of people who knew each other and who were more or less all in the same deals all the time. And he believes that that's where this notion of a preferred return was born and came from. Number 23 says he started building a portfolio that he's planning. He started building a portfolio that he's planning to sell to Blackstone. Number 24, he says he really believes in trying to keep control of his assets and not to be controlled by investors. And I like this concept, and I like this lesson and this message, because given the goal of building 1.25 million, a portfolio of 1.25 million properties, with 1 million being in Africa, 150,000 in the US, and 100,000 in the rest of the world, it's good to think through, like, how do you do that and stay in control? So I appreciated that lesson from Grant Cardone. Number 25, 5, still on the preferred returns, it says get off of preferred returns. It's not fair to you and your investors. Preferred and redemptions misalign. So the sense I got from this is that preferred return probably from a cash point of view, maybe a cash flow point of view, is a drain for the GP, the one who's running the property and the deal. So something to think about. Number 26, he says his Cardone Capital contract with the LPs who give him money to invest in real estate has a no redemption offer. And so for him, this is clear because real estate, the reason why is clear because real estate is an illiquid asset, so no redemption. Number 27, says don't offer a 3 to 5 year exit, offer a 7 to 10 year exit. And I thought to myself, ouch. Now he tells me, because the deals that we're working on to close those 2 units in Cape Town, 11 units total, but 2 deals. The first deal with 2 units and the second deal with 9 units. We're pitching a 3 to 5 year return using a 3 plus 1 plus 1 term for the capital. So something to think about, especially going forward. Number 28, he was asked for advice about raising kids and being a good dad, and he talked about homeschooling. So this is something that he's very passionate about, and I must say I'm really taken and swayed by his arguments. And because of the way we raise Claudina and Gilbert, we always give them a chance to have a say in things that impact them. So I've brought it up to them once or twice, and very clear that they prefer to stay in school. But one of the benefits of homeschooling that really got my attention is you actually then have a lot more time with your kids because they're not in school all day. And when you homeschool them, you also have much more say over the curriculum and what they learn and even how they learn it and when they learn it. But one thing that I think makes homeschooling the most compelling is I've never really agreed with this notion that children have to wake up so early to go to school. I mean, out here in Texas, where I now live in the Austin area, the elementary schools are the ones that start the earliest. So like as early as 6 something in the morning, kids are already getting on school buses. And it wasn't very dissimilar, or it was quite similar when Claudina and Gilbert, for example, were growing up in Nairobi, Kenya. So don't like that at all. So I think homeschooling then allow kids to have more sleep, one, but also to not have to worry about getting up so early and getting ready to go to school. Anyway, I digress. Let me continue. Otherwise, I might either go into more in-depth detail or into a tirade about schools. Number 29, advice to dads. He said, to add value, you need passive income. He says that your income and passive income is income that doesn't require your 8 hours or even for you to be around. So we talked a little bit about that in the very beginning. So yeah, this is consistent with what Cardone teaches. Number 30, he says, and these are his words, bust your ass to earn extra money. I would have said bust your assets, but Cardone speaks much more plainly. Number 31, when you earn extra money, change the quality of your assets. Love this. Makes total sense, and it's clear from his story that this is what he's been doing. Number 32, don't spend earned income ever. Take $20,000 if that's what you have in earned income and invest it. Or take $20,000 if that's what's left from your earned income and invest it. So here again, it's really admirable and noteworthy that he's so disciplined with money. I certainly am not that disciplined with money, so I admire that he is. Um, Number 38 says you got to have boots on the ground. So when you're doing deals and uh, you need someone to walk the property, it's really important to have someone on the ground that can go and take a look, kick the tires. And in some ways, uh, this advice is something that's difficult to carry out with buying assets internationally, like the ones we're buying in Cape Town. But I do appreciate and agree with this when and where it's possible. I wonder, it would be interesting, and when I get a chance, I'm going to ask him, like, what does he think about, actually, I think someone's already asked him this, what does he think about virtual tours of buildings? And he did say he prefers to have boots on the ground. So yeah, there you have it. Number 30, what now? Oh, number 33, don't invest with banks. He doesn't trust them, says they lie. Don't invest with banks. I tend to agree when it comes to savings, and I'll do a video talk about the difference between investing your savings in banks and investing your savings in real estate. And get into the comments and let me know, would that be a helpful video to share with y'all? How the pros and cons of investing in real estate with your savings versus investing your savings in banks? Let me know. Continuing, number 34 says, don't invest in IRAs. And he's the second mentor that I found in this journey of building intergenerational wealth and understanding and raising my financial literacy, who mentions that individual retirement accounts, IRAs, 401ks, are not necessarily as good as we've been led to believe they are. So this is a video for another day, and just so y'all know, I'm sharing information, right? So I'm not a financial planner, so I'm not saying don't invest in IRAs. I'm saying this is what Cardone says, and this is the reason why he gives. The other person who says that also is Mark Kwan. He was the one who introduced me to this buy, borrow, die concept and raised my financial literacy about insurance products and investment products, and the borrow part. Like, he is someone who's a guru in understanding that. So especially if you have assets that you lever, like your stock and depositing things in brokerage accounts and the like. But I digress, so let me keep going. Number 35, go for fixed rate debt. He says he has 36 fixed rate loans and 5 variable rate deals. And I appreciate the wisdom of someone who was able to lock in fixed rate debt on such a high percentage of his portfolio. So where possible, I'm going to try to emulate this. This would be negotiations with the banks and figuring out what's the best way to do that. And especially getting fixed rate debt when interest rates are low makes a lot of sense. Okay. Number 36, it says, what you see in Excel spreadsheets pro formas mean nothing. And this was a bit of a surprise given how much Grant is driven by the numbers, but I think I take his point to be more so that the seller and the broker for the seller, who tend to be the ones behind the pro formas for the real estate assets that they're selling, have an incentive to, lie would be a strong word, but although I think Grant Cardone would use that word, but at least embellish or polish or make the numbers look better than they really are. So I can understand that. I can appreciate that. And number 37, he says, for every $100, or this was said in the podcast, every $100 of real estate is probably worth about $25,000, whether you're saving that $100 from expenses or you're growing it from revenue. So this is the whole notion of the multiplier effect within real estate of money and income, especially if you're dealing with multifamily or units or apartment buildings where and other commercial property where the value of the property is based on the income, the net operating income. Yeah, $100 could be worth a lot, especially with the calculation of the value being that the net operating income is divided by the capitalization rate, and then that gives you the value. So I could totally see that. Number 38. No, I think we'll talk about that. Gotta have boots on the ground. So I think I've jumped around a bit, y'all. So 38 is boots on the ground. Number 39, Cardone Capital. He says he picks the deals and he focuses on location. Then he focuses on getting great assets from distressed sellers. So he tends to buy from institutions. He's done multiple deals. He tends to try to do multiple deals at once now. Did 4 deals worth 1.1 billion at one go. And I just thought, wow, that's amazing. Can't wait to get to that level. Number 40, he wouldn't touch any off-market deal. Didn't quite understand why not here, except I know he tends to prefer to buy through brokers. So even if a broker is not involved in a sale, he prefers to buy through brokers. And the way he teaches us in his real estate club about this is by sharing that the broker then creates another line of buffer between him and the seller. And if he needs to negotiate, then he can negotiate more effectively with the broker as intermediary. Broker in the middle. Okay. 41. He only wants to deal with a seller who must sell. So one of the things he teaches us to do is to qualify the seller before doing a lot of work in the deal by figuring out, is this a market seller? Meaning, will this person be willing to sell at the rate in the market? Because if they are not willing to sell at the market rate, and then you don't have a willing seller. They would most likely hold the asset if they don't get their price, whereas a market seller will sell based on what the market would bear or what the market is pricing the asset at. Number 42 says if he has to, he pays cash and then he leverages later or put debt on it later. This was so helpful because in the deal for the 9 units in Cape Town, one of the things that I realized is that the debt service coverage, the paying down the principal and interest, was making the numbers look really bad. So the idea then came of like, hey, what if we could raise 100% equity for this and hold it for some years, and then once the cash flow is built up and net operating income is built up, then put debt on it and pay the equity providers back. So it's good to think creatively and about these things after learning from gurus like Grant Cardone. And that's one of the things I love about real estate, y'all. It's so clearly a field where you can be creative and try different things and come up with different ways of doing things. In some ways, it reminds me of my favorite topic, tax strategies. So just the creativity of thinking through what are we trying to accomplish and what are the different ways of doing that. Continuing. Number 43, don't cut anyone out. So this was a wake-up call. So he says he deals with both accredited and non-accredited investors. So he sends out a check on the 15th of every month. And the reason why he wants to ensure that non-accredited investors are able to invest with Cardone Capital is because a lot of his family members are non-accredited investors. So I thought that was compelling. And most of the others that I've read or listened to would tend to say that when you're raising capital, don't deal with non-accredited investors. It's just a headache. It's much easier to deal with accredited investors. But this Grant Cardone seemed to be a contrarian on this one. He disagrees. Number 44, he's raising 150 million, and he's doing so without identifying an asset. His pitch is basically like, when I find the asset, the capital will earn you, for example, 3%. Don't know if this was the number he cited or just something I put in my notes. Number 45, he's already talked about this. No preferred, distribute every month. 13. He tries to fit in 13 checks a year, y'all. So that means in December he tries to make sure that there are 2 checks. And then he looks for properties that are cash flowing. So remember, for those who may have seen the video of explaining lessons learned from Barbara Cochran, she specifically says she doesn't focus on cash flow, but Cardone does. And he says he targets 6 to 7% cash flow returns, and then he targets 2 to 3 times returns. He says he gets the 80-20 split on all the cash flow and any of the upside, and he returns capitals through a refi in 4 to 7 years. He returns all capital to investors tax-free, and that could be through a refi, a sale, or a real estate investment trust, but he doesn't believe in a waterfall process. So the 80-20 split, I wasn't clear, like if he's saying that he gets the 80 as a GP and then everyone gets the 20 as LPs, or he gets the 20 as a GP and they get 80 as LPs. I think it might be the latter way, the second way, but I'm not 100% sure. My notes weren't that good. Okay, number 46. He says his superpower is persistence and being extremely disciplined with money. He watches it, never loses it, tries to multiply it, and he believes in the little guy. And again, that discipline with money is so admirable that's something that he does. Definitely not the way I currently operate. Number 47, his goal is to own over 100,000 units and be one of the largest multifamily operators in the world. So this was eye-opening but also pleasing for me, because Grant Cardone is the one who taught me to think bigger. And now I'm hearing his plans. So he's planning to go from 12,000 to 100,000. That's great. As I've already shared, I'm trying to go from 3 to 1.25 million. And probably sounds ridiculous, but that's how big Grant Cardone taught me to think. And I thought, like, if I'm going to think, let me think big and go out there and do everything I can to make it happen. Okay. Number 48 says his first fund was only for accredited investors. So now he works with all investors. We've already talked about why. Number 49, he says the SEC is there to protect the institutions. And Mark Kwan also helped me understand some of the things that happens with these regulatory bodies, I guess, or oversight bodies. Conversation probably for in-person webinar seminars. Number 50, number 49, number 50, Grant Cardone is a thoughtful contrarian. That's what I wrote in my notes, because the more I listened to him, the more I realized he thinks deeply, and he does have a view that's contrary to, I guess, the established view or popular view, as the case may be. Number 51, real estate can't be an SBF situation because it's tangible. So here he's making an allusion to Sam Bankman-Fried and Alameda Capital, and yeah, so number 52, he says it's easier for someone with bad credit to get a loan on 200 units than to get a loan on a house. I remember the first time I heard him share this in December 2022 at his real estate summit. It was such a refreshing eye-opener to realize that when you buy rental property, especially multifamily rental property, apartment buildings, you're buying a business. So in many ways, it makes sense that the bank, if the bank's going to give you money for that asset, they're more focused on the asset than on you and your credit. Although I do believe that, I've heard it said that your credit still matters to a certain extent, but not as much as you would think. And bad credit won't stand in the way of a good deal. 53. It says money is a mirage. You are connected to every bank account on planet Earth as long as you can communicate effectively, frequently, and consistently. Trust is built on frequency and consistency. I like that formula. Number 54 is building 150 million fund to buy 450 million in assets. Number 55, buying real estate is really a sales job, not a buyer job. So learn how to promote and communicate effectively. Okay. Number 56, if first thought needed money, and didn't finish that one, y'all. So I'm gonna skip that. 57, now know that it's the deal. Then okay, I think I understand. So going back to 56, when he got into real estate, he first thought that the most important thing was having the money. And then later he realized that it's the deal, then the debt. So it's how good the deal is, then the debt. Okay, almost done, y'all. Almost done. Number 57. Now he knows that it's 58. 10,000 units is easier to do than 1,000 units. So this goes back to the old way he's spoken about why it's important to go big. The bigger you go, the easier the deal from the point of view of there will be so many people working to help you to do the deal on all sides, from the bank side, from the brokerage side, and so on and so forth, from the legal side. Number 59, second to last one, it would be easy to buy 10 billion. It would be easy to buy 10 billion. It would be easier to buy a $10 billion real estate investment trust than to buy a portfolio. Would have loved for him to say more about that, but he did not. Number 60, last one, learn how to get attention and promote by communicating effectively. All right, y'all. So this one was a long one, but thought it was important to share with you the nuggets from Grant Cardone. Always great to listen to Grant and learn so much each time I listen to Grant. Hope you gained something valuable from this video. And if you did, won't you please press the like button? And for those who are gaining from watching my channel, won't you please subscribe? If you think others will benefit from watching this video, won't you please share it? And if you want to know when I will be making new videos, won't you please press or click on the bell icon. All right, y'all. See you soon.